Something important is happening in the global financial markets right now, and many people are seeing headlines about Dow Jones Futures falling without fully understanding what it actually means or why it matters. Before the US stock market even opens, investors all around the world are already reacting to economic news, geopolitical tensions, interest rate expectations, and commodity prices. And one of the clearest signals of this early reaction is something called futures. Futures markets operate almost 24 hours a day, and they allow traders to speculate on where major indexes like the Dow Jones Industrial Average might open when the regular market begins trading. When you hear that Dow Jones Futures are rising or falling, it doesn't mean the stock market has already moved, but it does indicate how investors expect the market to behave when the opening bell rings. Recently, Dow Futures have been experiencing strong volatility, and this is not happening randomly. Markets rarely move without a reason, and right now there are several powerful forces pushing investors into a more cautious and uncertain mindset. One of the biggest factors affecting markets today is rising global tension and instability in important regions of the world, especially those connected to energy supply. When geopolitical uncertainty increases, financial markets usually react very quickly because investors hate uncertainty more than almost anything else. When there is uncertainty about trade routes, global conflict, or economic policy, investors often pull money out of risky assets like stocks and move towards safer investments, such as government bonds or commodities like gold. Another major factor influencing Dow Futures right now is the rapid movement in oil prices. Oil is one of the most important commodities in the global economy because it affects transportation, manufacturing, and energy costs for businesses around the world. When oil prices suddenly rise, companies often face higher operating costs, and that can reduce corporate profits. Investors know this, so when energy prices jump sharply, the stock market can react negatively because future earnings expectations become less optimistic. At the same time, rising oil prices can contribute to inflation, and inflation is something central banks around the world are trying to control very carefully. If inflation rises again, central banks may decide to keep interest rates higher for longer periods of time. Higher interest rates make borrowing more expensive for companies and consumers, which can slow down economic growth. This is why financial markets watch every economic signal very closely, from inflation reports to employment data to commodity prices. All of these factors combine to influence investor expectations about the future of the economy. But beyond the headlines and the short-term volatility, there is an important lesson that many long-term investors understand. Markets are constantly reacting to news, fear, and speculation, but the long-term direction of markets is driven by economic growth, innovation, and productivity. If you look at the history of stock markets over many decades, you will see that periods of fear and uncertainty appear again and again. Financial crises, wars, recessions, political instability, and inflation scares have all caused temporary declines in markets at different times. Yet despite these challenges, markets have historically continued to grow over the long term as businesses innovate, economies expand, and new industries emerge. This doesn't mean short-term volatility should be ignored. In fact, volatility is an essential part of how markets function because it reflects the constantly changing expectations of millions of investors around the world. But it does remind us that market movements like falling futures are often part of a larger cycle rather than the beginning of a permanent collapse. Many professional investors actually pay close attention to futures markets because they provide early signals about sentiment. If futures drop sharply overnight, it usually means traders are worried about something significant, whether it's economic data, geopolitical events, or corporate earnings announcements. On the other hand, when futures rise before the market opens, it can signal optimism and confidence among investors. These signals help traders prepare for the day ahead, but they also remind us that financial markets are deeply connected to global events. What happens in one part of the world can quickly influence markets thousands of miles away because capital moves instantly in the modern financial system. News spreads faster than ever before, and traders react within seconds. This speed of reaction can sometimes exaggerate market movements in the short term, which is why experienced investors often focus less on daily headlines and more on long-term trends. For everyday people who are watching the news and wondering what falling Dow futures might mean for their financial future, the most important thing to remember is that markets are naturally volatile. Short-term fluctuations are normal, and they are often driven by emotions like fear and uncertainty rather than fundamental economic changes. In fact, many of the world's most successful investors have built their strategies around remaining calm during periods of market panic. Instead of reacting emotionally to every piece of news, they focus on long-term investing principles, diversification, and patience. When markets become uncertain, the goal is not to predict every short-term move, because that is extremely difficult even for professional traders. The goal is to understand the broader economic forces that influence markets and to maintain a disciplined strategy. Dow futures, like all market indicators, are simply signals about expectations in the moment. They reflect what investors are thinking right now, not necessarily what will happen over the next year or the next decade. Markets are constantly adjusting to new information, and those adjustments can create both risks and opportunities. History shows that periods of uncertainty often create some of the most important moments in financial markets because they test the confidence and patience of investors. Some people react with fear and exit the market entirely, while others view volatility as a natural part of the investment journey. Ultimately, the story behind Dow Jones Futures today is not just about numbers on a screen. It is about the way global events, economic policies, and investor psychology interact in a complex system that moves billions of dollars every day. Understanding this system can help people interpret financial news more clearly instead of reacting to headlines with confusion or anxiety. Markets will continue to rise and fall, sometimes dramatically, because that is the nature of investing. But behind every movement, there is a combination of economic reality and human behavior shaping the direction of global finance. So when you see headlines about Dow futures falling or rising, remember that they are simply a reflection of how investors around the world are processing the latest information and trying to anticipate what might come next in an uncertain but constantly evolving financial landscape.